Well, welcome to Chapter 12, where we'll talk a little bit about taxable income and tax payable for corporations. It's important to note that there's a small business deduction that the government implemented that reduced the effective federal tax rate on eligible income from 11% historically to 10.5% and then eventually down to 10%. And then as more recently has reduced that now to be 9%. In these situations, it's actually lots of the wealthy folks would leave money that they wouldn't need it into their corporations and therefore be avoiding or delaying future taxes or current taxes and to be paid in the future. And so the tax on split income was expanded in 2018 in order to reduce the access to the income splitting with that corporation. And then any passive income starting in 2019 amounts in excess of $50,000 reduce the annual limit for the small business deduction for those organizations. Now, in order to get from your accounting income to your taxable income, there are a laundry list of additions and deductions that an organization needs to make in order to get to the net income for tax purposes, which we'll comment on some of those key items in a moment. Additions could include income tax expense, amortization, any recapture of CCA, reserves deducted in prior years, as we talked about in the previous chapter, losses on dispositions of capital accounts, pension expense, research and development, warranty costs, debt discount, foreign taxes paid. Also, excess of taxable capital gains over the allowable capital losses, interest and penalties on income tax assessments, automobile costs that are non-deductible, half of business meal costs, club dues and rec fees, non-deductible accounting reserves, charitable donations, asset impairment, and fines and penalties. Deductions from accounting income for taxable income would include CCA, capital cost allowance, the first $3,000 of incorporation costs, any terminal losses, deductible reserves, gains on dispositions of capital assets, the accounting amounts, pension funding contributions, deductible research and development costs, deductible warranty costs, debt premium amortization, foreign non-business tax deduction, allowable business investment losses, and landscaping costs. Once you've gone through these lists of additions and deductions, you then get to the net income for tax purposes. There are some deductions not available to corporations for determining taxable income, and they include the lifetime capital gains deduction, the employee stock option deduction, any lump sum payments, being a northern resident, or social assistance and workmen's compensation deductions. Now, deductions that are available to corporations are losses, which are the same as individuals. Charitable donations are considered a deduction rather than a credit, and dividends, which are unique to corporations. If we walk through a little example here, dividends, if the corporate tax rate was say 30%, and an organization may have made a dividend payment of $1,000 to company B, and if B was taxed, they would actually only have a net dividend kept of $700 after paying 30%. If they then distributed dividends to company C, another 30% of that would result in net cash to C of $490, creating an effective tax rate in the system of 51%. There's a significant problem with this where a 51% tax rate is not inconsistent with any integration discussions. So the solution is to allow corporations to deduct the taxable dividends received from other taxable Canadian corporations. Slightly different scenario talks about when you receive dividends from untaxed income. So in the first example, a corporation is taxed at 20% and they say had $100. So the corporation would have paid $20. The individual would pay, say, 30% on the amount being dividended out to them, which is the 100 less the 20 tax in the corporation. So 30% of the $80 remaining is $24 in tax for the individual. The total tax paid in this transaction would be $44. If the corporation is not taxed, the individual pays $30, which is 30% of the full $100 in tax. The total tax in that situation would be $30 compared to $44 when the corporation is taxed. Currently, there's no real solution in the Tax Act to respond to this. A little example when we're comparing debt to dividends on preferred shares. If an organization has debt that pays an 8% interest rate, if the corporation is taxed, say at 30%, the net effective cost of that interest would actually be 5.6%, being 70% of the 8% paid in interest. If the corporation was not taxed, it would be the full 8% cost. Say they had preferred shares at 6%, because it's a non-taxable deduction item, The after-tax cost is 6% regardless of whether the corporation is taxed or not. Redeemable versus retractable preferred bonds. There are different accounting rules that we need to consider, and various tax legislation ignores specific accounting rules. Now, when it comes to dividends, there is a stop or loss rule, and in order to stop people from avoiding taxes, this anti-avoidance loss is disallowed if it's owned less than 1 year, or if the corporation owns more than 5% of that payer, the issuer of those shares. So this scenario is, what if you bought the shares at $10 each on June 30th, you got a $1 dividend, which is tax-free on July 1st, and then you sold it on July 2nd for $9 a share. So you have a capital loss of $1 per share. In that situation, you have a tax deduction for the capital loss and dividend income tax-free of the dollar each. So you're actually gaining a gap. Under this anti-avoidance loss, this deduction and add back would be disallowed. For foreign source dividends received, they are not deductible for tax purposes. That is, there will be tax paid on it. It is included in income, as we talked about in a previous chapter, based on the pre-withholding amount, and a credit against tax payable becomes available based on the foreign tax potentially paid. There are some exceptions that you can note in chapter 20 later on. We're going to walk through a little non-capital loss carryover situation where we have a business loss for the organization of $60,000, where dividends received were 10, bond interest was 5 received, allowable business investment loss was $3,000, taxable capital gains of 15, and allowable capital losses of $7,000. They also had a net capital loss carry forward of $8,000. Alright, using the Income Tax Act Section 3 rules, there'd be non-capital gain of $15,000, being the $10,000 dividends received plus the $5,000 bond interest. There'd be net capital income of $8,000, being the taxable capital gains in the year 15 less the allowable capital losses in the year 7. And the sum of those two items would be $23,000. Subtracting our non-capital losses of 63, we have a net income for the year of nothing. We cannot go negative. And the available from previous year net capital loss carry forward would continue at $8,000. However, there are a couple of alternatives that the organization could consider, such as no net capital loss deduction or a net capital loss deduction of $8,000. Under alternative 1, where we have a non-capital loss with no net capital deduction, we'd start with a business loss of $60,000, add the loss from the investment loss of $3,000, the allowable business loss, and the dividends of $10,000 for a $73,000 net loss. Add in the Income Tax Act Section 3 loss of $23,000, add that back, and you'd have a non-capital loss of $50,000. The other alternative is to use the non-capital loss with a net capital deduction of $8,000, which means we'll use up the net capital loss. We'll start with a business loss of 60, the investment loss of 3, reduce the dividends of 10, the net capital loss of 8, so total net loss of 81,000, and then you apply Income Tax Act Section 3, which has an add back of 23, so you have a non-capital loss of $58,000, which effectively converts the net capital loss to a non-capital loss. There's a little more details as required on pages 589 to 591 of the textbook. Now, when we're talking about the ordering of taxable income deductions for corporations, it's not as restrictive as individuals. But some of the common considerations are the timing, where the OLS must be used before others of the same type, but there's no other restrictions on the order. There are some constraints in that it's restricted by income type only or time only, and some are by time and income specifically to farm loss carryforwards. There's a little more detail on page 591, 592. Another consideration is about the geographical allocation of corporate income. This is where an organization has permanent establishments in various provinces across the country, and is specifically related to if they have a fixed place of business, whether they keep stock in those specific provinces or own land or equipment in those. It's also based on activity in those permanent establishments, and it's based on gross revenues and salaries and wages as two key drivers. It's a simple average of the two in relationship to the gross revenues earned by those provinces or by those locations. A good example can be walked on page 593 of the text, but we'll walk through one here as well. If we look at the gross revenues in this example, where we have three provinces, Alberta, Manitoba, and Ontario, totaling $1 million with the amounts indicated on the slide. The percentages allocated to each province under gross revenues would be 25% Alberta, 40% Manitoba, and 35% Ontario. Looking at the salaries and wages allocation for the organization, where they have $500,000 in total allocated to those three said provinces, they would result in 20% to Alberta, 40% to Manitoba, and 40% Ontario. A simple average would determine that 22.5% overall for Alberta, 25% due to gross revenues, and 20% due to salaries and wages. The average of the two is simply calculated. This is the average of 20 and 25. Would be 22.5% of the taxable income would be allocated to Alberta. Similar calculations for Manitoba would result in 40%, and Ontario at 37.5%. So the allocation of the revenue, $100,000 earned by the corporation in the year, would be $22,500 to Alberta, $40,000 to Manitoba, and $37,500 to Ontario. When looking at federal tax payable, there's a basic income tax taxable rate of 38% of taxable income for corporations. There's a federal tax abatement meaning a 10% reduction in the taxable income based on what's earned in that province, and it's allowed to offset some of the provincial tax charged in that location. That federal tax abatement is reduced if not all the income is earned in a province where they earn income outside of Canada. There's also a general rate reduction where it's 13% of the full rated taxable income, resulting in a general federal corporate tax rate of 15%, assuming 100% of their income is earned somewhere in one of the provinces of Canada. So the key provincial corporate tax rates, the general rates do vary across the provinces, as can be seen on the screen, between 11.5% and 16% in the samples provided. And yet there is a small business rate that varies between 2 and 6% in those same provinces. So an example where we have tax payable with $100,000 taxable income, there's a basic federal tax of 38%, being $38,000, an abatement of 10% because 100% was earned in the country, of $10,000 credit, and a general rate reduction of 13% of the $100,000, resulting in total federal tax at $15,000. Let's assume a provincial tax rate, say of Alberta or BC, at 12% of the $100,000 of taxable income, would add $12,000 in tax for a total tax rate for this organization of 27%, resulting in $27,000 in tax owing. Some of the goals to be aware of when discussing corporate taxation are that there are incentives for small businesses in order to encourage them to start up and operate. There are also incentives for certain business activities, such as scientific research, where they get additional incentives from the government. There's also incentives for certain regions, where certain or locations across Canada are given incentive through investment tax credits or other programs. And lastly, there's a goal of integration, where regardless of where the income is earned, it's the same tax rate applied, no matter what the original source of the income is or who the ultimate recipient is of that said income. Another area of consideration is the small business deduction in the Canadian Tax Act, where there's an objective to provide some relief to small businesses to encourage them to earn active business income as an investment in their operations, and it allows for accumulation of capital on a new business as they continue to grow. Basic concepts for the small business deduction include that they must be a Canadian-controlled private corporation with an active business income. There's also an annual business limit of $500,000 in most provinces, and associated companies have to share the $500,000 limit. A little example, the small business deduction with $100,000 of income in 2019. Federal tax rate would still be applied at 38%, offset with a tax abatement of 10%. So the tax before the small business deduction would be $28,000. The 19% deduction allowed for small businesses would create a credit of $19,000, resulting in a federal tax of $9,000. Let's assume they're in a province with a provincial tax rate for small businesses at 3%, would provide a total tax payable for this small business of $12,000 or 12% overall. All right, continuing the conversation about small businesses and specifically CCPCs with property income. There's a problem where interest and rent might involve an active business, so it needs to be reviewed to determine whether it's property income or not. The specified investment business will not get the small business deduction in that case. And in general, businesses with 5 or more full-time employees are not specified investment businesses for this process. If it's interest or rent that's incidental property income, it's treated as active business income. And if it's from associated corporation that deducted that amount as an expense, it's treated as active business income for this organization. There's a process when calculating the small business deduction, where the Section 125 specifies the deduction as 19% of the least of the 3 items listed on the screen. One being net Canadian active business income, the second one being taxable income, less the foreign non-business tax credit, and the third being the annual business limit being $500,000. Alright, there's a reduction for the small business deduction for large corporations, where the reduction is the formula where it's the corporation's annual business limit times the excess of taxable capital employment in Canada, TCEC, over $10 million, divided by the maximum TCEC of 15 million times the 0.225% of 11,250. So if your organization has between $10 and $15 million of taxable capital employed in Canada, there's a reduction. Once you exceed over 15 million, it's a full reduction. In order to determine the TSEC, the taxable capital employed in Canada, it's the gap determined debt and equity capital of the corporation. Take away any debt and equity investments in other corporations. When not all of the corporation's taxable income is allocated to a province, the resulting amount is then applied by that same percentage that's applied to the abatement in order to determine the portion of the total capital that's employed to Canada. An example where if 80% of their income is allocated across the provinces and 20% is foreign, 80% of the total capital, taxable capital, would then be applied for the formula. When looking at the small business deduction for passive income, you need to look at the aggregate investment income. Put all the extra detail on page 606 of the textbook, but it's adjusted and it looks at interest and royalties, the net taxable capital gains on non-business assets, dividends received from taxable corporations, and dividends received from foreign So specifically, this reduction would look at the corporation's annual business limit of the year, which would be $500,000 at most, or smaller if they have associated companies, divided by the $500,000 base, times 5 times E, which is the adjusted aggregate investment income, less the $500,000 limit. And it looks at the corporation and any associated companies. An example of an organization or a type of organization that's not eligible for a small business deduction are personal service corporations, where an individual established a corporation to provide employee-like or employee-type services to that organization. They can only deduct salaries and other expenses that would normally be available to an employee in this case. Management companies, where they're organized to provide services to an unincorporated business, such as a professional practice as identified on page 608 and 609, they are eligible for a small business deduction as long as the markup on their services are reasonable, and in this example, not exceeding 15%. Professional corporations in most provinces are allowed to incorporate, and this has reduced the need for management companies as mentioned in the previous slide. In general, they are eligible for the small business deduction. Examples of these professional corporations would include accountants, dentists, lawyers, doctors, vets, chiropractors, but specifically would exclude engineers and architects. The next area to talk about is the manufacturing processing profits deduction. Now, it's a tax credit. It's only on manufacturing and processing income, and it's in alignment with the general rate reduction as talked about previously, being 13%. For those organizations that qualify for the MNPP deduction, they do not get the GRR, and it has no effect on the federal tax. However, it does benefit at the provincial level. Specifically, Ontario and Saskatchewan have a special rate for organizations in these sectors. This is an example using similar figures we used earlier in this lesson, actually, and in the same effective tax rate, assuming the provincial tax rate was 12% of $27,000. Calculating the manufacturing processing deduction under Income Tax Act Section 125, it's a tax credit that's equal to 13% of the lesser of the MNP profits, less amounts eligible for the small business deduction, or the taxable income, less the small business deduction amount, 4 times the foreign business income tax credit, and the aggregate investment income under the Act Section 129, which discusses interest, net taxable capital gains, rents, and capital losses deducted. The eligibility factor of this deduction is that at least 10% of the gross revenues need to be from manufacturing and processing, and specific definitions can be found in the Income Tax Section 125, but we don't go into detail because it has no effect on the federal tax payable. Just a reminder, the general rate reduction is 13% of the full rate of taxable income. For Canadian-controlled private corporations, the taxable income is reduced for any income eligible for the small business deduction, also by income eligible for the manufacturing and processing deduction, and reduced by any income eligible for refundable taxes. For non-CCPCs, taxable income is only reduced by income eligible for the MNP reduction. Jumping over to foreign tax credits now, the basic concepts for it is that there's a gross pre-withholding amounts are included in income. We talked a little bit about that earlier chapter. There's a tax credit for any withholding taxes by that foreign country, and the withholding rate is established by a treaty with that said country. For a non-business or property income foreign tax credit, it's the lesser of the actual foreign non-business income tax paid and the amount determined by the formula on the screen, where it looks at the foreign and non-business income divided by the adjusted division B income times the tax that would otherwise be payable in that situation. You can find more details on page 615 and 616 of the text, but when we're looking at non-business property foreign tax credit, the adjusted division B income looks at net income, take away any net capital loss carryovers deducted, and any taxable dividends received or deducted. The tax otherwise payable will look at Part 1 tax, plus any abatements. If the actual withholding tax amount exceeds the limit allowed under the prior calculation, there is no carry forward, but the excess can be deducted under the Income Tax Act Section 2012. The next section talks about business income foreign tax credit, where the credit is the least of the actual foreign business income tax paid, the amount determined by the same formula, or the tax otherwise payable less any non-business foreign tax credits. When completing the formula in the previous slide, the adjusted division B income is based on the net income less the net capital loss and taxable dividends received and deducted, and the tax otherwise payable will be as calculated under Part 1. Other considerations for business foreign tax credits is that you're allowed to carry back those credits 3 years, or you can carry forward for up to 10 years for any unused amounts. The last credit we'll talk about in this chapter are the journalism labor tax credit, where it's equal to 25% of eligible labor costs of that qualified organization. It is capped, however, at $55,000 per eligible employee, reduced by any financial assistance from any level of government, and other eligible In order to be an eligible newsroom employee, they have to be employed by a qualified organization, work at least 40 weeks, work at least 26 hours a week, and 3/4 of their time they must be engaged in the production of news content. And that's the end of our walkthrough for Chapter 12. The end.